You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is Education Wednesday. It is time once again for Options Bootcamp, the premier program for options education. My name is Mark Longo from theoptionsinsider.com, as well as, of course, on the ever-exciting Options Insider Radio Network, both of which kicking off their 15th year here in January. So a lot of craziness going on in the markets, and it's a fun time to be celebrating anniversary. We're going to do some fun stuff here, probably extend it. We're going to take the Disney approach. Disney likes to celebrate their, whatever it is, the 50th anniversary. They do it for like 2 years. We're not going to go that crazy. We'll probably have some fun stuff throughout the year here. So look forward to a fun 15-year extravaganza here in the year of our Lord 2022. And joining me to help me commence the festivities on today's program, none other than the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to Ye Old Options Bootcamp program, sir.
Hey, my friend, it is great to be back. Hopefully we got some nice and exciting things to do today.
I think we do. Before we get there, so I think the folks all want to know what's your rating. We need some music for that. We'll have to look into that for you.
Oh, yes. Well, we've got lots of things. We've had this week BBIG, which climbed quite a bit.
Big back on the radar. I haven't seen that one in a little bit.
Yeah, that one had a nice big old move, which was pretty cool. SDIC, those are the main ones.
Yeah, good old Vinco Ventures. The last 5 days from 264 up to looks like 526 or so, and then back down to $4 again. So yeah, had a nice run, more than doubled, and then coming back down on it again. So yes, good old Vinco. The short squeeze still alive and well in 2022, Mr. P. And you know what else is alive and well in 2022, listeners? A little bit of the old options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
Yes, so festive, so celebratory here. Every episode on Options Bootcamp. Welcome to Options Drills, a segment where we break down some options tip or technique or strategy and maybe give you a little bit more detail on how we utilize it, what you can expect, how it may impact your portfolio here. And it's that time of year again, listeners. We're coming up upon it. In fact, we're pretty much in it right now as we are recording it. Yes, it is earnings season. Once again, a lot of the big financials popped off last Friday, and that usually is seen as kind of the hallmark, the unofficial start to earnings season. It used to be Alcoa back in the day. Now things have shifted a wee little bit. So a lot of big financials were popping off last week. They have continued into this week, and other names are flying fast and furious, hot and heavy. We're about to really get into it. The first few weeks into week 3 are really interesting times here for earnings season. And of course, I know earnings season is a big time for a lot of you options traders out there. A lot of you like to dive into different names that are popping off and have a lot of strategies you like to implement and utilize around earnings season. So we thought it was a good time to maybe revisit this topic. I know we have some questions. We'll get to those in a little bit as well, but it's a good time to revisit the notion of earnings. If you want deeper dives into earnings trading and options, listeners, I encourage you. I know a lot of you have. We saw the numbers. We talked about them on our top 10. A lot of you went back and started with episode 1. But there are multiple episodes on earnings trading in the archive, some as recently as last August and last July. So go back, look at it. This is a topic we've touched on multiple times, which is why I'm not going to spend the whole episode on it, but it is worth a refresher here because, again, it's an important time for a lot of people. And as we kick off this new year, no one really knows what to expect. So it's a good thing to arm yourselves with some data. Let's arm ourselves with Mr. Passarelli's use case for earnings as well. Because I know, Dan, you're a big fan of earnings trading. In fact, a lot of what you do out there, I always joke about the rating, but a lot of what you're doing out there when you're not rating over there is trading in and around earnings. I know you have a whole approach. You have a whole system. So walk us through a bit of that, Mr. P. Why are you so interested in earnings? What was it that attracted you to it? And what is your approach to earnings season, sir?
Yeah, Mark. So it's kind of interesting. I tell this story in a webinar that I'll be doing tomorrow night. But it's kind of funny because I don't know if it was like this with the firm that you were at, although you were in the SPX, as I recall.
Yeah, I started in the S.
Yeah, but like for me, being in the equities, my trading firm, my risk manager would not allow me to trade earnings, wouldn't let anybody trade earnings. And, like even like at the height of my trading career, I was like, I was in like the top 5 guys at my firm, money making wise, but I was allowed to do basically anything, but I couldn't trade earnings because it's just so unpredictable. And that's a very common story. Like I think most professional traders are not allowed to trade earnings. So there was this one day where, long story short, found myself on the phone with a producer from Bloomberg Television, and he wanted to interview me down in the pit. And I was pretty excited because it was the first time I was ever going to be on, TV in front of millions of people talking about this stuff. And I said, well, what do you want to talk about? And he said, well, Apple has earnings coming out after the close today. We want you to give our viewers a trade idea on how to trade Apple earnings. And I was like, oh, crap, because like I never did it before. Like I was always disallowed from having a position going into earnings. So like I looked around and like, I told him I'd call him back, and I went and I looked at my platform and looked at, well, I can't buy calls. I can't buy puts because those are directional. Nobody can predict direction on earnings. It'd be dumb to sell naked puts or even cash cured, covered calls, credit spreads. Like none of it made sense. But I looked at a time spread, and like there's certain criteria that have to line up. A lot of it has to do with the volatility term structure. There's more to it than that, but certain criteria have to line up. And I was like, holy cow, this is a good trade. And it just sort of evolved from there. And, I've been trading it ever since and improving it ever since. And then a couple of years ago, I rolled it out to our students, and we chat about it all day long in our chat room, and people are trading it constantly. And it's good.
So is that where you awakened to the glory of time spreads around earnings, sir?
Yeah, I mean, that was my first thing because like I was just always like, oh, no, can't trade them, can't predict direction. But, like when you're doing time spreads of this nature, you don't have to predict direction. So it becomes like a different trade. Like you're really putting statistics on your side. Like it's more of a professional trader based strategy.
I hope the guy you didn't tell that Bloomberg reporter to do a time spread in Apple starts. I think you would have blown their minds.
Yeah, I know. They prefer as simple a strategy as you can get. But
you want to buy Apple stock? Okay, sure, we can get behind that. Yes,
right.
Maybe these days, if you tell them to buy a call option, maybe they get what you're talking about. But back then, you said time spread and Apple, they would have hung up the phone on you immediately.
Yeah, I know, man. But these days, I'll tell you what, some of their reporters have gotten a lot, savvier. Like Abigail Doolittle, she's like my favorite reporter on there, and she's very option savvy.
They have gotten better over time. That is true. So the time spreads, obviously earnings tend to play out a certain way. And again, there's no set pattern, but this is the way they usually tend to play out, listeners, which is, of course, you have a big name, could be your Tesla, could be whatever name you want. They usually have a regular sequence, a regular cycle on which they tend to announce their earnings. And if you look into the options chain, listeners, that week or that month will usually tend to, ahead of time, retain a little bit more juice, have a little bit more volatility, a little bit more premium in the options than the ones immediately surrounding it, because those don't have that extra bit of uncertainty baked in, which is why some people like to sell options around earnings, because they like all that extra juice they're getting. But of course, the downside is you could have your face ripped off quite easily in earnings. So that's the challenge. That's one of the reasons why, and I'll get into this more in a second, that's one of the reasons why we really started talking to the folks over at ORATS and got them to really start crunching the numbers on this, because there really wasn't a lot of hard and fast data readily available until we started doing this a few years ago. So you're welcome, A, and B, we'll get into more of that in a second. But Dan, that's the way the earnings generally tend to go. The vol gets usually bid up, remains a little frothy, a little bit juicier during the time frame of the earnings announcement. And then once the announcement happens, barring some sort of extreme surprise, usually we see that vol collapse. I've made the analogy many times of, you can think of earnings volatility as a balloon, and the balloon is filling up with more air, and that's the earnings announcement time frame options. And then once the announcement happens, unless again something crazy happens, that balloon's going to pop, all that vol comes rushing out, and the jig is kind of up. So with that type of scenario, the way it usually plays out, how do you approach time spreads in that scenario?
Yeah, so that's the gist, but like the other side of that same, so that's the thing with volatility, right? Like there's two types of volatility, and this is a pure volatility trade. There's no direction at all involved. And so one type of volatility is implied volatility, and the other type is historical volatility. So one is measured by Vega, and one is measured by gamma. And so you kind of have to balance those two out. And without a visual aid, it's a little bit hard to explain in great detail on the podcast, but that's the gist of it. So, you want to what you described is like about 50% of the strategy is looking for that disparity in term structure, if you want to use the fancy terms here for it. But when the term structure is like, when you're able to sell a much higher volatility than you buy, it can be very beneficial. But then I've got like a series of screens on how to look at like the gamma portion of it. Basically, I break it down. I'm actually doing a webinar tomorrow night on this, and it's a lot easier to explain in detail when I can use like some visual aids and kind of set the stage for how this goes. Do you mind if I share a link with folks to be able to register for it?
Go for it, sir.
All right. So if anyone's watching this and you're interested in trading earnings, this is a pretty good introduction anyway to how this all works. And you could go, like, all you have to do is go to markettaker.com/register. And that should bring you to a page to register for the webinar. And there's going to be one tomorrow night on this. So, it'll, like, for all the details and the finer points, that's going to be a great place to start. And, since it's you guys here from the podcast, at the end, I actually also give a real special deal for people who want to participate even further. So if you think earnings might be your thing, and earnings can be a really great thing, sign up for that webinar. It's free, and we'd love to see you.
In general, Dan, you're looking at time spreads, generally long time spreads, I'm assuming, not a lot of short time spreads, but that they do pop up. In fact, that is part of some of the earnings trades we're going to talk about in a little bit. looking at the data we have on this, but I'm assuming you're looking at long time spreads. And would you say you generally stay in the weeklies, so you're trading immediately around the event, or do you more stay with the monthlies? What's your general structure?
Yeah, so it's always long. Well, it's always long time spreads, or when they fail, when the long time spreads don't trigger, it's possible that there could be another strategy, and like if they're that far off, it could trigger a straddle. But straddles are often really, really tough to trade going into earnings because of that volatility balloon that you mentioned. But every once in a while, the balloon's just, it's not full enough to pop enough to be a problem, I guess, if you will. And it's that balance between vega and gamma. But with the long time spreads, the option we're selling is always the one that expires immediately after earnings. And it doesn't have to be it doesn't have to be a weekly. Usually I love weeklies, but today, last night, I was able to put on a really nice one in JBHT that they don't have any weeklies. It's just monthlies. Haven't really traded one that didn't have weeklies in a while, but it met all my criteria really nice. And that one worked out really, really swell. It's like a 32% profit overnight, basically.
I was just going to ask you about straight up straddles. You beat me to it, sir. It's like we're simpatico here on this show or something. But you're right. Earnings, that's usually the question people ask us. Say, hey, should I be general long or short premium going into earnings? And the answer is really neither. The real answer is really it depends. Coming in straight up slinging long or short straddles or flies or iron condors, that could be challenging. But we have a question about that right now, in fact, straddles. If you want to go over there to @options listeners on Twitter, make your voice heard right now. Our buddy, Mr. Overby, he's been asking this question a lot on his Options Playbook radio show, which is coming up live to tape a little bit later today, our second part of our dual extravaganza that is Options Education Wednesday here on the network. But he's been asking, he did a lot of long straddles on his show. There's a lot of trade recommendations there. And he was kind of wondering out loud if he was going to be doing a lot more long straddles coming into 2022. So we thought we'd ask you guys that same question. Long straddles, very popular in Options Playbook Radio last year. Do you think they will remain popular and perhaps even profitable this year? And Dan, what do you think our audience is voting for? We gave them yes, no, and I prefer short straddles. How do you think the early voting is shaping up?
Oh, okay. So that's a great question. So my answer is emphatically yes. I think last year, straddles started working a lot better, particularly for earnings. I traded a higher percentage of straddles during earnings, so still way more time spreads, but a higher percentage of straddles for earnings. I mean, this year is probably going to be the year of the straddle. It's just they've been getting better and better. Again, not like universally trading. I'm not just like, hey, I'll go put on a straddle on everything. Like that's not going to work. But when you really pick your spots, this is going to be a good year for them. I'm just going out and saying that right now.
Interesting, because Brian was kind of thinking maybe the opposite. That's why he wanted to put the question out. He wasn't sure if he's going to be doing a lot more straddles. Right now, Mr. Dan, our audience emphatically agrees with you, sir. 55.6% saying, yes, they do prefer straddles. Only about pretty much a tie for the other two, 22% saying no, and 22% saying they prefer short straddles. So the other two slugging it out. Mr. Dan, you have your finger on the pulse of the audience, sir.
Yeah, I mean, it's these guys here these guys and gals in our flock here, they're learning, they're like really paying attention, moving forward. They're doing it. I like it.
They are doing it indeed. And if you are going to do it around earnings season, remember, listeners, it's a little bit more sophisticated than just coming in and getting crazy net long premium and crazy net short premium. Luckily for you, we have made it even easier for you folks because we have armed you with a whole bunch of really, really, really interesting. And prior to us doing this with the folks at ORAS, really me twisting Matt's arms and making this data available for all of you folks out there. You're really the only way to get this. I think there was a Goldman study like a decade ago, and there are a few proprietary houses where their research teams would do this every now and then for their very exclusive high-end clientele. We said, the hell with that. We're going to make this available to everyone out there completely free of charge. And so that's what we've been doing for years now here. You can go to our website, theoptionsinsider.com, click on the options, news, and articles tab. You'll see earnings season reports out there, and that will kick off your journey. And it's really all there, listeners. We give you a whole bunch of reports. We give you the earnings move reports, which is what the markets is currently pricing in for a straddle comparison. It goes a lot more beyond that, listeners. It also shows you what they've actually delivered in the past, and it gives you a historical average. Usually it's over 12 quarters, so it's kind of a rolling average over 12 quarters, so about 3 years there. We also show you, the expected versus delivered, the price difference. They have forecasts baked in there as well. So a lot of cool stuff that you can arm yourself with the earnings move report. Once the announcement actually happens, we have the earnings move results reports where you can see what they delivered versus what was being priced in. Then beyond that, we have a new addition to the reports. Used to be 3 of them. Now we give you 4 for free. This new one is really pretty cool. This kind of goes back to what Dan was talking about. And this is something that, as Matt and his team have been crunching this data, they've kind of gotten a little bit intrigued by this as well. Because the general viewpoint for earnings for a long time, for a lot of pros, has been just stay the hell away from them, like Dan's risk manager used to say, right? Because it's completely unpredictable. And unless you want to take a huge directional bet, it's kind of hard to trade. There's a lot more nuance to it than just that, though. And so that's why Matt and his team have started to explore some trading opportunities in there. And they get into some of that with their earnings trades report. Now, the season just started, so I don't see any new trades in there yet. We're probably going to get some updated reports from them actually tomorrow for our option block show. So I expect some new trades in there. And they've broken it down into 4 categories, which I'm sure Dan will find attractive. They have your straight up buying straddles and selling straddles, which is kind of the entry level trade that everyone likes to talk about and wants to know about around earnings. And they get a little bit more sophisticated. They get into Mr. P territory. They talk about buying calendars and indeed even selling calendars. And it's pretty fascinating stuff. They break it down by the number of trades they're doing. They break it down by week, how they perform in different weeks. And looks like right now, weirdly enough, in their historical sampling, which, again, they haven't done a ton of trades. The most trades they've done is buying the straddle, 209 of those. That's only made about 0.42%. That hasn't been the best so far. 155 is number 2. That's for selling straddle. That's made 1.63%, so a little bit better. Let's see, buying calendars, 145 of those at about 1.25%. Actually, the best percentage return is selling calendars. They've only done about 70 of those. And again, that's a very esoteric trade. I don't see a lot of people really doing that. Selling the longer term, buying the narrow term is kind of the reverse of what you have come to know and love from calendars out there. But that one doing a little bit better. Again, only 70 of those. That's a little bit more esoteric. We just started doing this report really towards the latter portion of last cycle. So we haven't even had a full season behind this yet. So it'll be good to see this report get updated with some new data this cycle and see how things are kicking off. And also, speaking of the season, we also give you listeners completely for free, because we like you folks out there so much, the earnings season report. And again, this season just starting. So far, week 1 was a burner, 170%. That means if it's 100%, that means the market delivered exactly how much movement was being implied by the amount of volatility. They pretty much moved in line with their straddles, listeners. So 170% means the market moved only 2x. Again, that was only 7 firms that had been tracked at that point. So don't read into that too much. But again, a banger of a season so far. If you look back historically, though, remember, these are running over the past trailing 12 quarters. So you really only have 3 years that we're looking at here. So bear that in mind. The majority of that's going to be biased by the pandemic. And you can see that in these numbers, because the averages for earnings season have all been negative, have all been below 100%. So far, the best week to actually buy premium has been week 4, 92%. And the worst week to buy premium has been week 2 at 62%. But as you can see, none of them have made money so far. Again, last season was a bit of a game changer. We finally saw maybe the cycle begin to change, the worm begin to turn, people buying vol. It actually made money for them for the first time since the pandemic kicked off. Will that continue? Well, that gets back to our long straddle question from earlier. If long straddles are working, people are making money buying vol out there. So it'll be interesting to see how these numbers look once we have a few more earnings data points behind us. By the way, the heaviest week for number of firms reporting is week 4 with 269. That's followed by week 3 with 250. So week 3 and week 4, a lot of the big hot tech names you folks like all report in that time frame as well. So those are interesting nuggets. And again, all of that, the earnings move results, earnings season, and earnings trade reports, the 4th one now, all available for you for free over there at the website, just because we like you folks. In fact, Dan, a little birdie, has told me that since you and I first started talking about earnings again on the show a few months ago, that you also have discovered Matt and his earnings data, sir.
Yeah, I've had several conversations with Matt, and we've done and we've talked a lot about this, and it's interesting because one of the things that Matt does here is he looks at what the predicted move will be based on the straddle, but that's not to me, that's not really what it's about, because generally speaking, well, no, I would go as far as saying that move is always predicted wrong, either too much or too little. And so I kind of don't like when people say, oh, this is the move predicted by the straddle, because it's wrong. And what my system does is it determines which way it's wrong. And if it's wrong because the straddle's too expensive, which, as Matt shows in his data, usually is, that's when we can potentially make money. And we've got to look at a couple other things, but potentially make money from time spreads. And when it's wrong because the straddle's not expensive enough, which is rare, but that happens sometimes, those are the times when it makes sense to buy the straddle. So yeah, it's interesting. Man, I want to have a couple more conversations with Matt because he's such a smart dude. And I just love talking to him about this stuff.
We call him the Oracle of New Hampshire for a reason, sir. But that shows you how long I've been doing the show with Dan now, 10 years. And he didn't even know until a few months ago that we had all this cool earnings data on the website there. So teaching folks and giving you folks new gifts, new freebies all the time over there. Speaking of gifts, let's see if we can answer some of your questions as we head on into a quick mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call. Speaking of gifts, you guys can always return the favor. We know a lot of you like to listen on demand on your device and your platform of choice. That's cool. We like it. You know, a lot of you, sometimes you're busy. Sometimes you can't make the live sessions, or maybe it's a bit of a hardship for you to join the secret club. We get it. We're cool with you guys listening on demand. And what we'll ask you then is just, hey, if you like what you're listening to, keep rating and reviewing it on whatever platform you're listening to, Apple Podcasts, Google Podcasts, Spotify, wherever you get it. So that a lot of new folks, as we've seen, there are a legion of them these days, so that new folks can continue to discover the show, just like our friend here, AJ Gentner, did with a 5-star review. I'm not sure. This may be from iTunes. I'll have to look and see, or it could be from Google. One of those. One of the many platforms on which our stuff is out there. He just said, best options pod. That's the headline of his review. He says, I started listening to their shows from the very beginning and have learned so much. Thank you, with multiple exclamation points. Well, you're welcome, AJ Gentner, and everyone else takes the time out there to listen and to review our stuff. So you're the one who went back to episode 1. That was you, AJ. Well, clearly a lot of people did, because it was, I think, number 4 last year, number 3 of our most popular episodes. So again, if you like what you're listening to, you want to have new folks continue to discover the show, then rate it and review it wherever you're getting our content out. Let's go out to there's another comment here. This comes from Aljo. Aljo says, I'm not surprised that Options Boot. Oh, this is what I was just talking about. Not surprised that Options Bootcamp 1 was in the top 10 last year. I'm one of the people who went back and started from the beginning. So put me in that column. Thanks a lot, guys. Well, there you go. It's Aljo, Dan. It sounds like an AJ Gentner, and obviously many others who drove our first ever episode into the top 10 last year, sir.
Wow, that's awesome, man. Hey, thanks for listening, and thanks for thanks for re-listening. Listening and re-listening.
Hey, we like all the listens. Listen, re-listen, live, after the fact. You want to go back and start it all over again. We love you all out there. Let's keep on rolling here. Let's go to this question here from Dan Ferguson. Another Dan. Too many Dans on the show this week. He says, hello, Options Bootcamp. First time, short time. Oh, I like that. He's one of our new listeners. He says, I'm one of those options noobs you always talk. You guys always call yourselves noobs. You're very mean to yourself. You're not noobs. You're beginners. You're getting started. Dare I say it, you're neophytes. Noobs. It's very pejorative. We don't like to say pejorative things about our listeners because you've discovered this show. Clearly, you are intelligent and discerning people out there. He said, I would like to see if I understand what you were saying about dividends on the last episode. He says, so if a dividend is declared, then it hits the call prices and boosts the put prices. And if the dividend is dividend more than the contracts will be adjusted. I get that pretty much right. Well, you don't say how much it should be more than that. It was $12.50 though per contract. Remember, it was not $12.50 per share. Some people got confused by that. It's 0.125 cents per share or $12.50 per contract. If the dividend is more than that, you could see a contract adjustment there in terms of strike. That's going to be the strike adjustment. Mr. Dan, any thoughts on your compatriot Dan's here? Do you think he has a firm grasp, I should say, on dividends and options, sir?
Well, yeah, but I mean, just a couple finer points. Like most companies' future dividend stream is fairly predictable. Like a lot of companies that pay dividends regularly, they like it that way. You know, they like their investors to know what the dividend's going to be, and hey, we try to increase it by a certain yield, blah blah blah, every now and then. So, you know, if it's just like a regular dividend, when it's declared, I wouldn't say it necessarily hits any price. It doesn't change any prices. It would be on the X dates, where basically the way I think of it is the call and the put prices actually stay the same, but the stock price jumps. So it's the call and the put prices relative to the stock price is different, or the stock price falls, I guess I should say. So, I mean, if it's a special big dividend, then maybe when it's declared, we have that scenario, because, and the best way to think of that is if you own the stock, you get the dividend. If you own the call, you don't. So the call is less valuable as a result of that big special dividend being declared.
Yeah, I should probably clarify. We were mostly focusing on that episode, Dan and everybody else, on special dividends. So that's kind of what we were focusing in on, because we had some questions about that recently, and those tend to fall outside of that regular dividend stream that Dan's talking about. Because you're right, the regular stuff, that's all kind of priced in ahead of time. Most people understand it. That's regular, that's feature, that's already discounted there and accounted for in the options price. It's the special stuff that tends to throw a wrench in the works. We kind of walked through the descriptions and the definition of how OCC clarifies and quantifies a special dividend versus a regular dividend. Go check out that episode if you want a little bit more clarification. So yeah, I would add that it's a special dividend we were kind of talking about, which is really what kind of gums up the works. And you get into all those other stuff we were talking about contract adjustments and everything else like that. Let's go to this one, Dan. How about some love for you, sir? How does that sound? You ready for a little love, sir?
I love, Mark.
You do love. We got Vincent here, Vincent KM. He says, hey, dudes. Well, hey, dude, back to you, sir. He says, I'm loving the show. Oh, and I bought Dan's book. So there you go, Dan. He's the one. So your sales of one last quarter, it was Vincent here. So you should send him a personalized note, sir. He says, I'm about halfway through the book right now. Great stuff. Well, there you go, Dan. So far, converting people to the dark side. He says, I was hoping you guys could do an episode that talks about the international options markets. What do they trade overseas? How do those markets differ from ours? That kind of stuff. Thanks for everything you do for beginners like me. Well, there's a lot to unpack there. Basic broad strokes there, Vincent, is the U.S. markets far deeper, far more liquid. We trade most of the options action you're going to be interested in is here in the U.S. This is really where the game is. Chicago was the Mecca, still is the Mecca. The U.S. is the Mecca for this kind of stuff. If you look internationally, you're going to see more fragmented, less liquid, less volume. Also in other areas where the options market is still kind of nascent, they've actually developed a pretty robust warrants market. You see that a lot in areas of Europe. We don't see that here in the U.S. because there's no need for warrants. We have a listed options market that serves that purpose quite admirably. Some other interesting nuggets if you want data on this here. Vincent, our friends over there at the Futures Industry Association, actually crunch these numbers twice a year. This is from their mid-year report of 2021. They break all global derivatives volume down for you here. So you can see the numbers for yourselves. Again, if you want to go to FIA.org, Futures Industry Association.org, you can see the reports there for yourself. I'll just give you the latest numbers they crunched from last year. Last year, North American exchanges were still leading the dance. This is futures and options, by the way, so global derivatives. The numbers on North American exchanges grew by 15.4%. European exchanges volume fell by nearly 12%. That's compared to the first half of 2020. Globally, the asset class people are most interested in, you can probably guess this, it's the equity options markets. That was trading volume on single stock futures and options soared 72.5% nearly 3 billion contracts. Equity index futures and options volume rose 32% to 2.82 billion contracts. Interest rate futures and options actually declined 4.2%. Let's see. Open interest actually grew, though, which is kind of interesting. Commodity markets, they say, rose by double digits. Energy was the exception. Remember, this is the first half of last year. Energy saw a bit of a resurgence in the second half, with both volume and open interest in energy down compared to the first half of 2020. NSE, the National Stock Exchange of India, continued to have the highest overall volume for any single exchange. So CME no longer the big dog anymore. A National Stock Exchange of India. Overall volume, 6.6 billion contracts for a single exchange. Now, a lot of that has to do with smaller size contracts and things like that too. So contract volume doesn't always tell you the whole story, but it is interesting. Up nearly 77% from 2020. Again, though, their open interest was only 14.6 million contracts. So that shows a lot of churn and burn over there. Brazil was number 2. Brazil's B3, second largest exchange by volume. Their volume was up 52% to 4.16 billion contracts. Their open interest over 10x what it is in India, 147.9 million. And then CME was number 3 with 2.5 billion contracts. It was actually down 10.4%. And OI was about 102 million contracts. That breaks it down for you a little bit there. Again, you can look into these reports for a lot more data over there. But basically, even though these other exchanges are doing more volume now in some areas, overall, in terms of global derivatives, U.S. is still the place to hang your hat. Mr. Dan, anything to add on maybe some of the differences or nuances between international versus U.S. options markets?
It's interesting that the Indian exchange has surpassed CME Group. But it is like contract size. Like years ago, the Kospi options in
Kospi used to be the big dog in Korea. Yes.
Yeah, but that's because it was such a small size that they attracted a lot of retail trading, and everybody was basically just gambling on them. There's some lessons to be learned there, I think, for some of the exchanges too, and maybe even some of the stocks out there that haven't split. A lesson either way for the exchanges. I mean, you get more volume if things are more affordable. It's hard to trade Tesla options for a lot of people. And maybe companies like Amazon and Tesla like it that way, so that there's less, gambling going on with their stock and more people who are serious about investing. There's something to be said about financial engineering. It's a real knack that a lot of really smart people have to get good at to make a contract work.
And that's going to do it for our episode here. Great questions, everybody, coming all over the place. So that's why we like you folks, giving us curveballs. I'm looking at the NSE website right now. Their hot options out there for today. It's the Nifty. The Nifty index is really what drives all their derivatives paper listeners. And looks like their Bank Nifty index, Jan 38,000 strike put, is the big dog today with 45,000 contracts on the tape out there against an open interest of 80,000. So doing some paper. These are expiring tomorrow, so probably some people are closing out some positions. And they got the regular Nifty index going up here. So it's Nifty. They also have one of the few international flavors of VIX. The Nifty VIX over there actually trades in India as well. One of the few successful examples of VIX licensing internationally over there. But really, it's pretty much all Nifty all the time over there. And you get some other regions, you get Shanghai rebar in China. Dan mentioned the Kospi in Korea. There are a few hot spots that do a decent amount of paper, but they are relatively few and far between. And Dan, if folks want to hit you up, maybe not to talk international options, or maybe they will, who knows, but they want to talk probably more along the lines of what we were just talking about with the earnings, trading, or get into your rating. Maybe they have more questions about the dividends. Where should they go? What should they do?
Yeah, absolutely, Mark. I will tell you what, if you're specifically interested in earnings trading, come to that webinar and you can ask questions at the end of that as well. It's just markettaker.com/register, and that'll get you registered for tomorrow night's webinar, and we'd love to see you there.
Check them out over there at Market Taker. Don't forget the second T, markettaker.com is the place to go. We got to go on out of here. We'll be back again later today, live to tape with Mr. Overby. What are we talking about? Long straddles? Who knows? I guess we'll find out a little bit later. You'll be hearing that live to tape on demand on the network. Back again tomorrow for TWIFO, as well as the episode 1 this week. There was no show on Monday for the Option Block, Friday volatility views, and of course, options oddities for all you Secret Club folks. Back again next week, all the way through to another Education Wednesday, another episode of Options Bootcamp. We'll see you then.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.